Here's the truth. Almost everybody buys backwards. They fall in love with a house first, then they run the numbers, and then, this is the killer, they talk themselves into the numbers. Rent's a little light, but hey, the neighborhood's coming up. Cash flow's razor thin, but appreciation will cover it, right? That one sentence right there has buried more landlords than any crash ever did. Now the operators who actually build empires, they flip it. They decide up front what every single door has to pay them, and then they walk away from every deal that doesn't hit that number. Cold, no emotion. Same market, same houses, same street, completely different outcome. Let me walk you through exactly how that math runs. Drop it in the comments. Which side are you on, for real? Be honest. Because most of us start out on the wrong one. Alright, so you want to run a rental property empire. Grab a few houses, collect the rent, let somebody else knock out your mortgages, and hang it up early. That's the pitch. And listen, it ain't wrong, the mechanics are real, but here's the twisted part. Most folks who try this end up grinding harder than they ever did at their 9-to-5, for less money, while sitting on $1 million of debt they can barely keep up with. The landlords who actually get rich, they're not the ones who bought the most properties. They're the ones who ran the math before they bought anything at all. By the time this video's done, you'll know exactly how rental empires get built from nothing, what the money really looks like once the expenses take their bite, and why the line between a cash-flowing portfolio and a slow-motion financial disaster usually comes down to one number nobody bothers to calculate. We're covering what it costs to get in the door, how the revenue model really works, the hidden costs that eat your returns alive, real operators who built real empires with real numbers, the one pattern that keeps wiping landlords out, and what the profit actually looks like in two concrete scenarios. So what does it really cost to step into rental property? Start with one unit. A single-family home in a mid-tier market, say Columbus, Ohio or Kansas City, priced around $200,000. To buy it as an investment property, you're putting down 20 to 25%. That's $40,000 to $50,000 in cash just to open the door. Then closing costs, another 2 to 5%. Call it $5,000 to $10,000. And you need a cash reserve because the second you close, something breaks. Figure another $5,000 sitting in the bank, minimum. So your all-in cost of entry on one property, before you collect a single dollar of rent, lands somewhere between $50,000 and $65,000 in cash. Now, if you want an empire, one unit ain't it. Most serious investors are aiming for at least 5 to 10 doors before they see real portfolio-level income. 5 properties averaging $200,000 each? You're looking at $250,000 to $325,000 in cash deployed just to acquire them, assuming conventional financing. Some people run a play called the BRRRR method. Buy, rehab, rent, refinance, repeat. You pick up a distressed property cheap, fix it up, pull your cash back out through a cash-out refi once it appraises higher, then roll that same money into the next deal. It works. But it takes construction management skills, solid contractor relationships, and a lender willing to do cash-out refis on investment properties over and over. Passive? Not even close. The other lane is commercial financing. Once you hit 5 or more units in a single building, banks flip you from residential to commercial loan terms. Interest rates climb, terms get shorter, and you're usually signing a personal guarantee and forming a business entity. Bottom line, building an empire takes either a whole lot of capital or a whole lot of hustle. Usually both. Alright, so how does the money actually move? Here's the model in one sentence. You collect rent, you pay the mortgage and the expenses, and whatever's left over is your cash flow. Sounds simple enough. The problem is, the gap between rent and expenses is almost always thinner than people picture. Take that $200,000 house in Columbus. Renting at $1,600 a month is realistic for a decent 3-bedroom. That's $19,200 a year in gross rent. Now your mortgage on a $155,000 loan at 7.5%, a realistic rate for a 2024 investment property loan, runs about $1,085 a month. That's $13,020 a year. And that's just debt service. $6,180 left before you've paid a single expense. That's your gross margin. Now watch the math get uncomfortable. Property taxes on a $200,000 house? Roughly $2,400 a year, though that swings wild depending on your state. Insurance on a rental, not your primary, runs about $1,200 to $1,800 a year. Maintenance and repairs? Budget 1% of the property's value annually. That's another $2,000. And don't forget vacancy. Even a beautiful property sits empty a few weeks between tenants. Budget 5% of annual rent. Call it $960. Stack it up. $2,400 in taxes, $1,500 in insurance, $2,000 in maintenance, $960 in vacancy. That's $6,860 in annual expenses sitting on top of your mortgage. So your cash flow on a $200,000 property renting for $1,600 a month? Negative $680 a year. Let that land. You are paying money to own this thing. And this is exactly where folks panic. It's also where the model gets interesting, because that negative number is leaving a few things off the table. Your tenant is knocking down your mortgage every single month. Out of that $1,185 payment, roughly $115 is principal in year 1. By year 10, it's closer to $250 a month and climbing. Then there's appreciation. Columbus home values have climbed about 4% a year over the last decade. On a $200,000 home, that's $8,000 in paper wealth stacking up annually. And then there's depreciation, the tax play. The IRS lets you write off the building's value over 27.5 years, which, on a $200,000 property, comes out to about $5,800 a year in paper losses you can use to offset other income, subject to income limits. So the real picture isn't just cash flow. It's cash flow plus equity paydown, plus appreciation, plus tax benefits. Investors call that total return. And on a leveraged asset, it stacks in a way almost nothing else does. Here's the catch though. Appreciation and depreciation don't pay your mortgage on a bad month. Cash is cash. So here's what sharp operators actually do. They don't run numbers on a house they fell in love with. They run the numbers backward from the cash flow target. They decide what they need to clear per door. Then they only buy deals that hit that number. The classic benchmark is the 1% rule. Monthly rent should be at least 1% of the purchase price. So a $200,000 house needs $2,000 a month in rent. Almost no market hits that at full retail, which is exactly why seasoned investors hunt off-market deals, distressed properties, and markets nobody's discovered yet. Now, the costs nobody warns you about. The ones that actually wreck people aren't the obvious ones. They're the ones that show up after you're already locked in. Tenant turnover is the monster. Every time a tenant walks, you eat 1 to 2 months of rent. You pay for cleaning, painting, maybe new carpet, advertising, and a property manager to screen the next tenant if you use one. Total turnover cost on a single unit? $2 to $5 grand, easy. And if you've got a tenant who stops paying and won't leave, now you're in eviction land. In a fast state like Texas, that's 30 to 60 days and $500 to $1,500 in filing fees and attorney costs. In a slow state, New York, California, it can drag 6 months to a year. 6 months of carrying costs with zero rent coming in. On a 3-property portfolio, one bad eviction can erase a full year of profit. Then there's CapEx, capital expenditures, the big-ticket items that don't hit every year, but they're coming. A roof is $8 grand to $15 grand. An HVAC system? $5,000 to $10,000. Water heater? $1,200. A full kitchen or bathroom redo on a rental can run you $10,000 to $25,000. And here's the thing, most new landlords budget for maintenance, but they never budget for CapEx. Those are 2 different buckets, my friend. Maintenance is oil changes. CapEx is a brand new engine. You need money set aside for both. Insurance gaps? That's another trap waiting on you. Standard landlord insurance doesn't cover floods. Doesn't cover mold remediation past some tiny little limit. One flood, one mold event, and you're writing checks for $20,000 to $50,000 out of your own pocket, if you're in the wrong zone without the right writer. Property management fees. You hire a manager, plan on 8 to 12% of monthly rent. On a $1,600 rental, that's $128 to $192 gone every single month before you touch a dollar. Now stretch that across 10 properties. That's $1,280 to $1,920 a month, up to $23,000 a year, just so you don't have to manage them yourself. And then there's interest rate risk. Most investors who built portfolios between 2010 and 2021 did it with cheap money, 3–4%. Then 2023 and 2024 hit, and rates jumped to 7 and 8. Anybody who bought at the top with floating rate debt, or who had to refinance, cash flow got crushed. Some folks went negative overnight, and there was no way to raise rents fast enough to make up the difference. So who's actually turned this into a real business? Let's talk about a few real examples at different scales. Marcus Delaney is the loudest name in the game. He started with one residential unit in Houston back in the late 1980s, lost money, sold it, bought it back, and eventually he cracked the code. He pivoted, apartment complexes instead of single-family homes. By 2023, his Delaney Capital Fund controlled over 12,000 apartment units across the Sun Belt, with a portfolio worth more than $4 billion. And his argument never changed. Scale kills the per-door math problems. A 300-unit complex has a full-time maintenance crew and professional management. A single-family home has you calling a plumber at midnight. He raises money from outside investors through private syndications, takes a management fee off the top, and earns a slice of the profits when properties sell or refinance. His investors get quarterly distributions. It works at scale because the expenses per unit drop, while the income per unit stays steady. Now let's flip to the other end. A regular person who figured it out. Devin Marsh, former podcast host over at Bigger Pockets, started buying small multifamily properties in Washington state in his mid-20s. Bought a duplex, then a 4-unit, then a 24-unit complex, all while working a regular 9 to 5. By his early 30s, he'd replaced his entire income with rental cash flow. His play was house hacking. He lived in one unit of every property and rented out the rest, which let him qualify for owner-occupied financing rates instead of investment property rates. Lower rates, lower payments, better cash flow right out the gate. He also bought in markets everybody else ignored. Mid-sized towns with stable employment bases, lower purchase prices, and rent-to-value ratios that actually hit the 1% rule. The common thread? Neither Delaney nor Marsh got rich buying what everybody else was buying in the hottest market. They found an edge, ran the real math, and only scaled when the unit economics actually worked. And then there's the failure story, because this one matters. So how do people actually lose their shirt doing this? The most common way rental property blows up in your face isn't a bad tenant. It isn't a collapsing market. It's over-leverage, paired with negative cash flow and zero reserves. Let me show you exactly how this thing unravels. An investor picks up 3, maybe 4 properties in a red-hot market. Prices are sky-high, so the cash flow is already razor-thin or straight-up negative, and they tell themselves the same lie everybody tells themselves. Appreciation will bail me out. So they put the bare minimum down on every deal to keep cash in pocket. Then, one of 3 things happens. A big repair drops on their head. A tenant stops paying for 4 straight months. Or rates jump and they've got to refinance. And just like that, they're short $2,000 a month across the portfolio. And the reserve account? Empty. So they start covering mortgage payments out of their own paycheck. Then, out of credit cards. Then one property slides into foreclosure, which torches their credit and trips the personal guarantee clauses on everything else. Domino effect. This wiped out thousands of investors in the 2008 crash, and it happened again to a smaller crowd in 2023 and 2024, when rates climbed faster than anybody on the planet predicted. Now here's the thing. The investors who walked out of both storms alive had one thing in common: enough cash reserves to outlast the chaos, and deals that were cash flowing from day one. So the rule is simple. Never buy a property that needs appreciation to make sense. Appreciation is the bonus. Cash flow is the business. Alright, so what can you actually walk away with? Let's run two real scenarios with real math. Scenario 1, the small operator. You spend 5 years building a portfolio of 5 single-family homes in a mid-tier market. Average purchase price, $200,000 each. Total portfolio value at purchase, $1 million. Cash invested, roughly $250,000 across all 5, including down payments and reserves. Average rent per property, $1,500 a month. Total gross rent, $7,500 a month, or $90,000 a year. Total mortgage payments across those 5 loans at 7.5% on $155,000 each, about $5,425 a month, or $65,100 a year. Annual expenses across all 5, roughly $35,000. That covers taxes, insurance, maintenance, CapEx reserves, and a 5% vacancy allowance. So annual cash flow, $90,000 minus $65,100 minus $35,000. That's negative $10,100 a year. You're bleeding about $840 a month. And at today's rates, in most markets, that's unfortunately the real picture. Which is exactly why experienced investors either bought further back in time, buy in cheaper markets, put more cash down to shrink the debt service, or get creative with financing. But hold up, look at the equity side. Every single year, your tenants knock down about $7,000 in principal across those 5 loans. And if those properties appreciate at 4% a year, you're stacking $40,000 in paper wealth annually. By year 10, at 4% appreciation, those 5 homes are worth roughly $1,480,000. You owe about $640,000 across the mortgages. Your equity? $840,000. You started with $250,000. That's a 3.4 times return over 10 years, roughly 13% a year, while you were cash flow negative the whole time. Then the tax benefits stack on another layer. Depreciation deductions, plus the ability to run 1031 exchanges when you sell. Defer the capital gains, roll straight into a bigger property, and your after-tax return jumps in a real way. And here's the beautiful part. The cash flow problem tends to fix itself. Rents rise with inflation. Your mortgage payment doesn't move. A property that barely breaks even today is often throwing off $300 to $400 a month by year 8 because rents climbed and your debt payment stayed flat. Scenario 2, the serious operator. You start with one duplex, house hacking it. Then you scale hard over 10 years into a 20-unit portfolio, a mix of small multifamily. Average purchase price per unit in a B-class market, $120,000 a pop. Total portfolio acquisition cost, $2.4 million. Cash you actually put in over that decade, about $600,000. And that includes equity you recycled out of earlier deals through refinancing. Average rent per unit, $1,100 a month. 20 units, so gross rent lands at $22,000 a month, $264,000 a year. Now, at this size, a property manager takes 10%, so that's $26,400 a year gone. Operating expenses and reserves, and I'm budgeting conservative here, 40% of gross rent, call it $15,600 a year. Mortgage payments across the whole blended portfolio at an average 6%, older deals locked in lower, newer ones higher, roughly $115,000 a year. So run the math with me. Annual cash flow, $264,000 coming in, minus $26,400 for management, minus $15,600 in operating expenses, minus $115,000 in debt service. You're left with $17,000 a year, about $1,400 a month landing in your pocket, real cash. Now, that ain't life-changing money, I know, but hold on. Add the equity paydown across 20 units, roughly $20,000 a year in principal knocked down by your tenants. Then add appreciation at 4% on a $2.4 million portfolio. That's $96,000 a year. Stack it all up and your total wealth building number sits around $133,000 annually. By year 15, assuming that steady 4% appreciation, the portfolio is worth about $4.3 million. Remaining debt, around $1.5 million. Equity, $2.8 million. And you started with about $600,000 invested. That's a 4.7 times return, roughly 11% annualized, plus the $17,000 a year in cash flow the whole way through. This is also the moment where refinancing or selling off a few properties becomes a real play. A 1031 exchange into a bigger apartment complex can squeeze down your per-unit management cost, push up the income per unit, and drive that cash flow number way higher. Operators who climb to 50, 100 units, they'll tell you the economics flip on you dramatically. At that scale, self-managing with a small in-house team actually costs less than paying somebody outside. One maintenance tech on salary runs you $50,000 to $60,000 a year and covers work across 50 units that would have cost you $150,000 in contractor calls. That's exactly why Grant Cardone's model chases 300-plus unit complexes. Below 50 units, property management is an expense line. Above 100, it turns into a competitive advantage. And there's one more revenue stream most small landlords straight up sleep on: short-term rentals on part of the portfolio. A single-family home pulling $1,500 a month long-term might do $2,800 to $3,500 a month on Airbnb or Vrbo in the right market. That's damn near double the gross revenue on the exact same asset. The trade-off is management intensity. Short-term rentals need cleaning between every single guest, constant communication, dynamic pricing, restocking supplies. Most investors who go this route either run it like a real operation, hiring a co-host or short-term rental manager at 20 to 25% of revenue, or they automate hard with smart locks, automated messaging, and professional cleaning crews on contract. Operators like Marcus Delaney, who's documented his short-term rental portfolio out in the open, have built 10 to 15 unit STR portfolios, pulling $40,000 to $60,000 a month in gross revenue. After every cost and management fee, the net is still often 2 to 3 times what those same units would earn as long-term rentals. Now the risk? Local regulations. Cities from New York to Phoenix to Barcelona have moved to restrict or flat-out ban short-term rentals in residential zones. Anybody building an STR portfolio better be watching local ordinances like a hawk, because one regulation change can cut your gross revenue in half overnight. Let's also talk about Let me give you the historical arc here, because the math on rental property looks wildly different depending on when you bought in. From 2010 to 2019, investors who scooped up property in growing Sunbelt cities, Phoenix, Austin, Dallas, Atlanta, Charlotte, basically couldn't lose. Prices jumped 60 to 100% in a decade, while interest rates sat near historic lows. Picture a 2012 buyer in Phoenix who put $50,000 down on a $200,000 home. By 2022, that house might be worth $380,000. On paper, that's $180,000 in appreciation on a $50,000 cash investment. A 360% return, and that's before you count cash flow or tax benefits. That era made rental property look almost unfairly easy. It pulled in a massive wave of new investors who assumed the good times were permanent. Then 2022 showed up. The Fed hiked rates from near zero to over 5% in less than 18 months. Mortgage rates on investment properties hit 7.5%, even 8% by 2023. Monthly payments on the exact same loan doubled compared to 2021. Anybody who bought in 2021 at the top of the market, heavy leverage, thin cash flow, they got caught. Rents just couldn't climb fast enough to cover the new carrying costs. Operators who had to refinance variable rate debt walked into brutal new terms. Some sold at a loss. Some handed the keys straight back to the bank. The ones who made it through? They bought assets that actually cash flowed, kept reserves in the bank, and never assumed rates would stay cheap forever. The lesson isn't that rental property stopped working. It's that it only works when you run it like a business, with conservative underwriting, not like a lottery ticket on appreciation. Here's the whole model in one sentence. You're using other people's money, your tenants' money, to pay off assets you own, while time and inflation do most of the heavy lifting, provided you bought right in the first place. So here's the real answer. Can you build a rental property empire? Yes, absolutely. Thousands of people have. But the path looks like this. 5 to 10 years of actively working deals, reinvesting every single dollar of cash flow, surviving at least one nightmare tenant or one ugly market, and staying disciplined while everybody around you is either panicking or getting greedy. The small operator with 5 houses isn't getting rich off cash flow at today's rates. He's building wealth through equity, riding appreciation, and using leverage in a way no stock portfolio can touch. The serious operator with 20 units is building a real business. Modest cash income today, serious wealth in 10 to 15 years, especially if he keeps trading up. And the folks who actually retire on rental income, the ones you see on YouTube with the before and after stories, almost every one of them built that portfolio before 2020, in markets that were dirt cheap at the time, with rates that flat out don't exist anymore. That doesn't mean you can't do it now. It means you've got to be sharper, more patient, and way more selective than they ever had to be. Because the dream isn't wrong. Passive income from property is real. It just comes with a price tag most people never read before they